All right, let's talk about the Andersons' latest quarter. This one is a fantastic case study because, on the surface, the numbers look like a complete disaster. But the market? The market saw something totally different.
So here's the big question, right? How on earth does a stock jump nearly 9% after missing earnings by more than 50%? I mean, seriously, think about that. They reported less than half of what Wall Street was hoping for, and the stock just soared. It makes no sense at first glance, but that's exactly what went down.
And just look at this disconnect. The analysts, the so-called experts, they were calling for 51 cents a share in adjusted earnings. What did the Andersons actually deliver? Just 24 cents. That's not just a miss, that's a massive 53% miss. 9 times out of 10, a number like that absolutely crushes a stock.
But this was that one time it didn't. The stock didn't tumble at all. In fact, it did the exact opposite. It shot up almost 9% in a single day. So what was going on? What did the market see that the headlines completely missed? Well, that's exactly what we're going to get into.
Okay, so to really get what happened, you have to understand that the financials this quarter were telling two completely different stories. It was like a tale of two tapes. There was one story for the bears, the pessimists, and a completely different one that the bulls just grabbed onto and ran with.
And this table just lays it all out, plain as day. You can see the bad stuff, right? The big miss on earnings per share and a pretty steep 33% drop in adjusted EBITDA. Ouch. But then you look over at the revenue line. Whoa, a massive beat. They brought in over $250 million more than anyone expected. And that right there was the first real clue that maybe, just maybe, things weren't as bad as they seemed.
So let's just boil it down. The bad news? Earnings and core profit took a serious hit, no doubt about it. The good news? They were raking in way more cash from sales than expected, and their operating cash flow was super strong, almost $300 million. Now, the market definitely liked that part, but the real reason for that huge stock rally? Well, it was something else entirely, something much bigger. All right, let's get to it, because this is the heart of the story. The market was willing to completely ignore the weak profits for one simple reason. Management pulled off a massive, game-changing move. A move that basically redraws the entire map for the company's future. And here it is, the big one. The Andersons went out and bought the other half of its ethanol business. They took full 100% ownership of their 4 ethanol plants from their partner Marathon. Now, this wasn't just some small deal. This was a huge bet-the-company kind of move, going all in on the future of renewables. So why did the market love this so much? Well, think about it. 1, they're now in the driver's seat. Full control, no more committees. 2, they get to keep all the cash flow from these plants. It's no longer a 50-50 split. 3, and this is the big one for Wall Street, the deal immediately boosts their earnings per share. And finally, the best part, there's almost no risk. I mean, they've been running these plants for years, so it's not like they're trying to figure out a new business. And you could just hear the confidence in management's voice. The CEO, Bill Kruger, he called it a pitch right down the center of the fairway. I mean, how perfect is that? They apparently looked at more than 20 other deals out there and decided, you know what? The best possible investment is to just double down on what we already know and do best.
And here's the number that really matters. Management came right out and said that this deal alone could add 70 to 75 cents to their annual earnings. And in a really good year, it could be over $1 a share. So all of a sudden, that 27-cent miss this quarter, it kind of looks like small potatoes, doesn't it? The market wasn't trading on the past 3 months. It was trading on the next few years.
Now, don't get me wrong, this huge ethanol deal doesn't just magically erase all the problems in their other businesses. To really get the full picture here, we've got to talk about the headwinds they were flying into this quarter.
And yeah, the headwinds were pretty rough. In the renewables biz, their profit margins got squeezed. The crush spread, that's basically the profit they make turning corn into ethanol, it got smaller. And at the same time, corn itself got more expensive. Then you look at their traditional agribusiness. There was just too much grain everywhere, not enough demand, and that really hurt their trading division. It was just a really tough quarter to be in the grain business.
But okay, for every headwind, there's usually a tailwind somewhere on the horizon. And for the Andersons, a huge one is something called carbon sequestration. Now, what is that? It's basically a fancy way of saying they can capture the CO2 that comes out of their ethanol plants and bury it deep underground forever. And why does that matter? Simple. The government is offering up massive tax credits to companies that do it.
And guess what? They're not just talking about it, they're already on it. The Andersons has already filed for a permit to get a carbon capture project going at one of their Indiana plants. So you got to understand, this isn't just about being green. This is a straight-up financial play that could open up a huge new stream of income for their ethanol business.
So you've got the huge ethanol buyout, you've got carbon capture coming down the pike. What's next? What should we be looking for? Well, management actually gave us a pretty clear roadmap for the next year and a half. Let's walk through the timeline here. Coming up this fall, we're expecting a big harvest, which should be good for their grain business. Then, mark your calendars for December 9th. That's their big investor day in New York, where they're going to lay out the grand plan. Fast forward to mid-2026, and some major new projects start coming online. And it's all building towards one big number, a target of around $4.30 in earnings per share by the end of 2026.
Okay, time to put on our analyst hat and pull this all together. What should we expect next quarter? And more importantly, what's the big picture takeaway here?
So my prediction for the third quarter, I'd expect the numbers to still be a little soft. I mean, those challenges in the grain markets aren't just going to vanish overnight. But I think we'll see things start to get better in the renewables business. Honestly, though, the stock price from here isn't really about Q3. It's all about the story they tell at that investor day and what happens with ethanol margins. So my rating on the stock is outperform. And here's the bottom line. I think this quarter was the turning point. The market is finally realizing that the Andersons isn't just a boring up-and-down grain trader anymore. Now, with total control of its ethanol plants and this huge carbon capture opportunity, it's turning itself into a real renewables powerhouse. And a company like that, well, it deserves a much higher price tag.
Okay, so to wrap it all up, here are the 3 things you absolutely need to watch. Number 1, those ethanol crush margins. That's the key number for profitability. Number 2, listen for any news on that carbon capture permit in Indiana. If that gets approved, it's a huge deal. And number 3, December 9th. That investor day is everything. The story they tell there will drive the stock for the next year. You know, the market has clearly bought into this new vision for the company. The big question now is simple. Can they deliver on it?
And just a quick reminder, as always, this is not financial advice.